You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
But I think the number one thing that we hold as far as strategy is finding optionality, because we know things could go wrong, and so optionality is key. In other words, having an asset that you can have other plans. If plan A doesn't pan out to be what we thought, then maybe we got another ground, maybe there's another target that we think it could potentially be just as exciting. And so having those options, I think, are even more important than management, in my opinion.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, and joining me today is Tavi Costa from Crescat Capital. He's been with Crescat as a portfolio manager for about 9 years, since 2013, I believe. And Tavi is very well known over the internet and podcasts and YouTube channels for sharing his insightful macro analysis, as well as his commentary on the mining and commodity sphere. But I invited Tavi onto the show today to talk a little bit more about how Crescat makes money specifically in junior resource stocks, what they do before they deploy, what's their exit strategy, what do they look for in a company and management team. So with that introduction, Tavi, thank you for coming on the show for the first time.
Well, thanks for having me. Looking forward to this.
Likewise. All right. Your due diligence process. I can see from your website that you take a team approach to due diligence before you invest in a junior resource company. Can you kind of walk us through what it looks like internally at your fund before you invest in a company?
Well, there's a lot of things that are involved with this. I think this starts with Quentin really signing off on the geologist side. If Quentin really appreciates what the asset it has and as far as the potential to be a world-class discovery, we're not looking for small things. We're looking for something that we believe it's going to be much bigger than other people believe. And so if we are involved, obviously there is a case in our end as far as the geology go. And then after checking that box, it starts to the due diligence process on the management team and the technical team. Technical team is, again, Quentin is the guy who would really work on that part. Management team, I would say all of us it's unfortunately, it's kind of subjective. It's regards a little bit of the history of the person, and really kind of gut feeling of meeting with them and seeing if they are onto something that we believe they can handle the stress of owning a company that we believe could be successful. And so it's very rare that we come into an investment where we don't like the CEO, that we don't like management, we don't do turnarounds, I think most people have figured out. What we can do sometimes is in some situations we really like the asset. We think the management is good. Therefore, we bring in some technical expertise to help them to come to fruition with their plans. And so that's really the beginning. Then it's all about sizing. After we check those boxes, we got to make sure that we like the sizing and how we would like to size. Usually, it depends on the position. We like to start as much as we can. We usually up to 20% partially diluted is our goal. If we can get up to partially 20%, it would be ideal, and that's just because, especially in that sweet spot of sub $10 million, that's usually how we try to negotiate things. As far as jurisdiction, I think jurisdiction plays a huge role. We usually have already places and areas that we would like to have exposure to. It's kind of rare that we get outside of those regions unless we think there's a new district play that we think it's going to be important to start adding exposure to. But most of the times we stick with the places that we like, which is the Golden Triangle, the Yukon. We've got some areas in Newfoundland. We got Nevada. Arizona is another part that we got a lot of investment, especially in the copper space. Bolivia is a place, believe it or not, that we have a different view than a lot of people. We think it's a good place to work with, especially if you got good connections. We avoid other parts of South America. We've got investments in Peru and Brazil. and one investment in Africa. We don't invest in Africa, at least outside of this investment that we already have. And Europe, we have one in a few in Finlay. In Finland. Finlay is the name of a company. And Australia is another place that we have investments too. So I think that gives you some ideas about the due diligence. Obviously, there's a lot more to go into it. We also like to model those what we think there is in terms of minerals. So we can kind of have an idea of what we think it's going to be the full potential of valuation at the peak of the Lassonde curve on exploration, which is usually 20% of the value of the mineral in the ground. And then we apply other adjustments when it comes to, risk of the dilution over time and the capex needed to put this into production, things like that, that we think are going to be important to discount the value of that asset, even jurisdiction risk as well, and the risk of maybe technical team not being as savvy as other technical teams that we have. But I think the number one thing that we hold as far as strategy is finding optionality, because we know things could go wrong. And so optionality is key. In other words, having an asset that you can have other plans. If plan A doesn't pan out to be what we thought, then maybe we got another ground. Maybe there's another target that we think it could potentially be just as exciting. And so having those options, I think, are even more important than management, in my opinion, because having an asset with a lot of optionality to me is essential. So I think that gives you some ideas of how we search for things. And one final thing is M&A. Make sure that those companies have some sort of probability of M&A from the major companies. So majority of the companies we come in is because we think they could be shocked by some of the majors. And so those are the key points. I hope I'm not missing anyone, but I think those are the key points.
Thank you for that, Tavi. I know a lot of funds in the resource space, they wait for that discovery hole before they take a chunk. But my understanding is your company will actually put up some millions into earlier stage exploration companies even before a discovery hole is published. Is that correct?
Yes. And the beauty of now, though, with valuations where they are, is that you're able to find a company with already a discovery hole trading sub $20 million market cap, which is unusual. To me, it's where just the market is giving us a gift right now to put money to work in things that we believe are, probabilistically speaking, onto something very interesting. And so, but yes, we view those as kind of call options per se. Those are prospective grounds that we think, again, have a lot of interesting targets, not just one. And so we like to fund those companies. Sometimes they're private companies. We've got a few private companies in our portfolio, and that's chasing that first discovery hole. And the
illiquidity of a private co doesn't bother your fund at all?
Well, we don't have much. It's less than 5% of the fund, so I guess liquidity is not a real problem there. And those are very small. So you're talking less than $1 million type of company. So you're funding that with hundreds of thousands of dollars. So it's not from a scale perspective. It's not, the liquidity won't really won't really be a problem in terms of that. So
when you invest in a junior miner, because you put out such great macro work, do you start at top down, find a bullish commodity, then filter down into exploration opportunities that are exploring for that commodity? Is that where you start? Or if you see a good geological team with a good thesis, would you take a bite out of that company, even if you're not overly bullish on the commodity they're looking for?
No, it has to be aligned with her macro views. We don't invest on things that are not aligned with her macro views. And it's important to know, even though people like to ask me questions about macro and all that, the gold part of our investments, the precious metals and base metals investments that we have in exploration, they are static. We're not really, we change some positions when things go wrong, or we change our views about an asset. Don't get me wrong. We will sell or buy more if we change our view. But it's a lot more static than a macro book, right? A macro book is liquid. You can really change things very quickly. You have to blend things on the other side. So for a global macro fund, which has a sleeve of that into precious metals, a precious metal strategy, which is mostly exploration assets, we have to treat that differently. So, I hope that makes sense. But that's, yeah.
So how do you measure success? I know a lot of gold fund managers will just measure their success relative to the GDXJ internally and with your investors. How do you compare yourself to determine if you're doing well?
Well, benchmarks help. I think GDXJ is one of them, as you just mentioned. But there isn't really a good benchmark to what we are doing, correct? Because there's no benchmarks for exploration. So GDXJ would be the closest. If you look at the median market cap for GDXJ, is nowhere close to the median market cap of our holdings. So, but there's no alternative. So, if you ask anybody, okay, what's the alternative? There isn't one. So it is what it is. Our portfolio is mostly in exploration, not because, first of all, we think we have a niche strategy in terms of that, but also given our views on the macro side of, we think gold will be trading higher, not lower 5-10 years from now. And so we feel comfortable holding those assets. And I think the biggest contrarian view about what we do as far as a fund compared to everybody else is that we take an approach of owning a lot of companies. And, we have done over 80 to 90 investments in the exploration space, invested over $200 million in the space. And so
in this last year, Tavi?
Last 2 years. And so it might have been actually a little more than that, but right now we have about two plus 100 million in the space. And so to us is or at least our funds, we also have separate managed accounts that should account for that. So that would be above 200. But my point is, a lot of people wouldn't do that. They would think that's a headache. I don't want to, deal with 90 companies in my portfolio. To us, it's a numbers game. It's owning an asset that is being run well, that has an interesting target, and we follow up with those companies. Quintin has 4, 5, 6 calls a day with companies, getting updates from them. On the technical side, I don't get involved in the technicals. I got to run the macro side. So it's all complementary. Kevin and I are more macro, and we work on quant models to help us to manage the portfolio. Quintin's more the technical guy on the geology, discerning new investments, looking at the plans that they have. And the biggest concern we have, I would say, is not that we don't like the ground, is finding management team that is open-minded to work with us. We're very easy to work with, but there are situations where we deploy capital in a company and directly say, this is where we would like for you guys to drill. And they don't drill there. And so, rather than getting in a litigation and all that, we just, we say goodbye, and we this is just not worth our investment. And so it all depends on the story, but there has been some cases that we had to divest.
I've seen you refer to your fund as activists. So would that be an example of becoming activists with the companies? Absolutely.
I mean, there's a lot of cases, and I would say people can ask the technical team of each of the companies we're invested. I would say that from those 90 companies, about 60 of them we're very close with. I mean, we keep in touch with them all the time. And the others are doing something more independently. But about 60 of them are we work closely. And I would say about 40 of those 60, we're very close to them. And so, sure, there are core investments in our portfolio that we've been working with them a lot more than other companies. So it all depends on, the level of success over time and what we find. But it's an exciting time to be deploying capital in such a depressed market, in my opinion. It's great if you're a long-term investor buying distressed assets here with a lot of probability to succeed. It's to me, it's it's where the opportunity lies ahead.
And so what would be your fund's exit strategy? Do you have like a 3 to 5 year plan here coinciding with your macro view?
It all depends on the case. I mean, if a company per se, so we use models to try to figure out, and then again, this is not doesn't mean the models are going to be correct, but it gives us a sense of where we should be exiting or where the valuation of the company is relative to what we think it should be. And if the model is out of balance, meaning the market is pricing the company at a higher level than we think it should, which it happened actually maybe 4 to 5 times because of this market has been so dismal over the last 2 to 3 years. Hasn't been a very frequent situation, but it happened, and we divested of those investments over time. But the exit strategy will really depend. I mean, it's I think, I personally think that it depends on, first of all, we haven't had much of M&A yet. So that I think that's going to play a big role into exit. Number 2, we would be happy to take things into production if it makes sense. We would be happy to consolidate things and find companies that have the infrastructure that can perhaps find some synergies to put some of the deposits that we found into production easier with an easier path. And we're certainly working on that on the sidelines. So it's difficult to say timing like that, but we definitely have a plan for every company that we invest. We think about that question a lot. Now, what's the peak of the Lassonde curve for exploration for this company 2-3 years from now? And every company will vary. In average is about 3 years, but this is all dependent on market activity as well.
Do you like to buy companies that are in that second trough of the Lassonde curve going into production? Do you buy pre-production companies?
We do, but that's a smaller part of a portfolio given our views about the macro environment. As we get into the later stages of what we think we're going to be, I think we're going to be locating a lot more capital into development. I just think that it's just the lack of folks covering exploration in general are just allowing a lot of inefficiencies, and that's where we found most of our best investments have been in that part of the industry. I would say we've had a lot of success stories. I would say SK Mining has been one of them. Newfound Gold has been another one of those. Eloro has been another one of those. And so
do you trim those when they go up so much? I mean, SK went up tenfold, I believe, and Newfound Gold just was like a rocket. Do you trim them as they go up? How did you play those specifically?
It depends on the story. SK Mining, we didn't do it because if you look at what they have, I mean, we think is just the beginning. But tenfold is all on perspective, right? I mean, we bought this very early, so it is a tenfold for us. Can that be trading at a $3-4 billion valuation at some point? We think so, and that's why we hold it. But again, with the news that we have today, shouldn't be. But we think it will, and so we like to hold it. Obviously, as you get to a later stage like SK Mining is. It's helpful because it reduces a little bit of volatility relative to the other ones, and so from a risk management perspective, it's actually quite interesting because you got a higher probability of getting it right over time, but also the volatility spectrum changes a little bit from the 10, 20, 30 million market caps, and so even though it doesn't look like, but it does. No, but we've trimmed other positions that we don't think that we believe they found everything that we think they have, and it just wasn't the case with ASCII. Definitely not the case with ASCII. But there are opportunities to sell in those situations when you have a large move. Again, I mean, the majority of their investments are for the long term. So if we find a company like ASCII Mining, our goal is to stay with them for the long haul. So I don't think there's much of a point. I don't think Eric Sprott made billions of dollars selling positions after they had a tenfold, right? I mean, I think he made money by holding on to most of his winners over time. And so it's not just Eric Sprott. I think the majority of the capital made in the industry came from folks that started exploration companies and did very well, or invested in very early stages of exploration companies and went through the whole Lassonde curve basically. And so, we like to, if we think there's quality, our opinion may change about SK Mining and others, but that's not the case right now. We're certainly very bullish about most of our portfolio, but there were cases where we sold off because we think we've seen enough. We've seen all we think we would have seen.
Avi, could you share about how your fund approaches exercising your warrants? I see your fund's name in a lot of press releases. You do financings, you get half warrants, full warrants. So are there some thresholds of how much above the exercise price a stock needs to be trading at before you'll exercise? Or is it more on a case-by-case basis where you're talking to management, seeing their funding needs? Can you give us a little insight here, please?
Well, that's a good question, but it's very unique. It's hard to talk about. I know it would be very specific cases here, I would say.
You got to keep track of them too, right? You got a long Excel sheet to keep track of all your warrants.
Well, I just want to say, we have a whole team of guys doing most of the programming of all the stuff that we have. So we know exactly what's coming up. We know the funds that we need and so forth. So we're aware of it. But it's it's a lot of work, and especially right now, a lot of things have sold off significantly. So a lot of warrants are out of the money. So which is fine. That means we don't have to fund them. But it depends on the case. I mean, there are situations where the strike is very close to the money. Or it's in the money, but it's still very close to going out of the money. But we know that the company needs capital to get their drilling for the season. What are you going to do? Not give them capital and not have them drill for the whole season? That's a position where we would certainly give the capital, and it will depend. Maybe we're going to let the strike or the warrant expire worthless and help them fund on a better situation for us. It all depends on the case, but. We're very much aware of their needs, their capital needs. That's something we track very closely. So we know, in our list, what's the capital need of most of those companies in the next 6 to 12 months. And so we're very much aware of what they need most of the times. Most of the times it doesn't come to us as a surprise when they need capital.
So what about hedging your portfolio? Because you're so bullish on the commodity and mining sector, are there any internal hedges you carry within the fund?
Yes, precious metals fund is mostly precious metals. So that's not the goal. Is not to be hedged in that direction. It does have the capability of hedging, but we don't want to hedge today just because of our views about precious metals in general. And so we stay. Well, that one is 100% long at this point. However, as I said, there's a flexibility to short as we get into later stages and we think things are getting frothy. We're going to get short. Or global macro and long short funds, which have a lot of those investments as well. That's a different story. That's we hold. So we have a large book of tangible assets, and then we have shorts in the markets. So we're short technology companies we think are going to get squeezed by margins. We have long dollar positions, and so different things, a lot of macro related positions. That's where I come in mostly.
I listened to a gold royalty CEO some weeks ago, and he was sharing about 5 years ago when he would be talking to funds. The funds did not care about what his company was doing on an ESG front. But now 5 years later, not only are they concerned what he's doing, they're having to manage the ESG expectations of the investors that are investing in their fund. How has the growing ESG movement with its demands affected your fund, if at all?
Not much. I mean, I think we came into to the mining space already at this kind of surge of ESG awareness. So nothing has really changed. I think perhaps one or a few stories have had issues when it comes to permitting their projects for whatever reason, political reason in some ways. But it's actually, I would say, rare in terms of the issues we've had. I think that we had other issues, but that hasn't really been one. We respect the ESG policies and so forth, and we just, I don't think we have had any problems so far as investments go. But very much involved with, I think at some point we're going to see some bigger involvement from governments to. Right now, we're so far away from that with the kind of, they're becoming more restrictive instead of helping companies to develop and explore and produce minerals in general. But I think we're going to see a shift of that at some point where the government is going to be forced to even provide subsidies and things like that to make deposits become economically viable and perhaps help them to be developed quicker. So I think we're maybe in a transition from extreme green revolution ESG policies to maybe into something that will look very different in the next 5 years.
And so does that cause you to be bullish energy, traditional energy, hydrocarbons?
It's tough because energy is different. Energy has a shorter cycle. It might actually have a longer cycle this time because of the political constraints that we have on investing in the space. But we take a different approach on energy because we also think it's a real movement away from oil, but it will take time. And so, acknowledging this, we stay on very liquid names. So we have most of our positions are liquid in that side, meaning a larger market cap spectrum. And so, we're bullish on energy in general. I mean, they're very profitable businesses, but we haven't taken the same approach that we've done with precious metals. So it's just a different investment strategy, but similar thesis.
Tavi, before you go, last question. Are you bullish on the agricultural sector right now? On an anecdotal level here in Michigan, the farmers I talk to, they say expect higher food prices because our input costs, our diesel, our grains, our fertilizer, land, equipment, everything has gone up dramatically in the last 2 years. And that usually will translate into higher food costs. But the farmer warned me also, he said, Bill, sometimes we spend a lot and make a little if the prices roll over. What would be your take on the ag sector?
We like agricultural commodities. They have gotten a bit here in the last weeks or so. Some of them are down almost over double digits, and some of them are, I would say, about 20+% or so. So it's been difficult, but it's we made money on those investments, and we think they're going to be attractive over time. And so we've been buying the dip in a lot of those grains and agricultural commodities and businesses in general. But it's been difficult recently. A lot of them really sold off. But we're bullish. We like them for macro reasons. Usually in an inflationary environment, you want to own agricultural commodities. And so we like to have a basket. So we have the precious metals and base metals basket with exploration mostly and some developers as well and some producers. And then we have a big chunk of oil and a big chunk of agricultural commodities. That's kind of our book today. And then we have the hedges on the other side. And I'm referring to global macro in this case, not precious metals fund.
Tavi, thank you for your insights today. What's the best way for my listeners to follow you online?
Just go to Twitter and @Tavi Costa is my handle, or you can find us also on crescat.net, our website. There's a lot of information about letters and research letters and in-depth research as far as our views.
Excellent. Well, thank you for coming on today's show, Tavi.
Thanks for having me.